I guess we'll go ahead and get started here. I say we'll have some people joining us in the next few moments, I'm sure, but just wanted to say hello to everyone. I'm Dr. Rebecca Mears. I'm a member of the VIN Foundation Student Debt Education team. Really excited to be here with you tonight. This is one of my favorite events that we do all year long. So I'm just really looking forward to it. Game plan is I'm just going to do some quick housekeeping stuff, and then I'll get it kicked over to Dr. Tony Bartels to take us through the new grad student loan playbook. We've worked out our chat issues, so that's awesome. Thank you guys for your help there. I appreciate it, and getting to see where everybody's joining us from as well. We'll leave the chat for any technical issues throughout the evening and actually use the Q&A for any questions. So if you have questions throughout the presentation, anything that Dr. Bartels is going over, or questions that maybe we haven't hit on those answers yet, feel free to use that Q&A feature. You can also ask anonymously there. So if that's, if it's a questions you're more comfortable asking that way, then you're welcome to do so. You can also upvote those questions so that we're aware of which ones are sort of the most pressing and that everybody's kind of having the same question about, so we can address that live. We will answer all your questions throughout the evening. If we don't get through it during the presentation, we'll work towards answering those questions at the end. And then I wanted to give a shout out to Jordan Benchia, who is the executive director of VIN Foundation. She's behind the scenes and will be helping answer some of those questions today. So any technical issues in the chat, otherwise let's use that Q&A feature down at the bottom and have some great conversation. But I'm really excited, and I'm going to kick it over to Tony. We can get launched into it.
Cool, sounds good. Thanks, Rebecca. I think I may ask you guys to reply in the chat a little bit. I've got a few questions scattered throughout here, or just some feedback. I've got some polls as well, so we'll try to keep it as interactive as possible. But make sure you're asking lots of questions. This is where the rubber meets the road, right? You guys are either already out the door, or half a foot out the door, or really close to getting on your way to becoming practicing veterinarians in some capacity, right? But a lot of you, and I'm guessing that's why you're here tonight, have some student debt and are looking for some specifics on how to take care of that. So we're going to walk you through that this evening. All right, so let's dive in. 37 days away. Yeah, very cool. The countdown clock is ticking. All right, so we want to help you set yourself up for repayment success. There's a lot of different ways that you can handle your student loans. Doing this for more than 10 years now, helping our colleagues come up with student loan repayment strategies. We've seen a lot of good, bad, and ugly, right? So we can kind of pick out the best practices from all those collective experiences that we've accrued over the years and pass those along to you, so you can avoid some of the same mistakes we've all made with our student loans. And lucky you get to graduate into what is probably going to be a different looking landscape. So you're going to be a little bit of the guinea pigs for what are some of the changes that have been proposed recently to student loan repayment. But the good news is that some of those changes are going to be really helpful and can make some of these strategies that we've been recommending for years even better, right? So we just want to make you aware of what's going on, so you can use that to your advantage as you're getting started, no matter where your career is going to take you. Can't manage what you don't measure, right? So you have to look at your student loan details. We're going to make you look at those. Some of you have already taken a look at those. If you filled out that student debt and income signalment form, thank you for doing that. There's some of that information is going to be peppered throughout this presentation, as well as some of you all being used as cases for tonight. Your repayment options, again, they're changing a little bit, right? I mean, they haven't changed yet, but they're going to be changing soon. So we want to make sure everybody's aware of what those changes are going to look like. It will affect what that quote best repayment strategy is going to look like. And depending on what your circumstances are, your best repayment plan is going to differ depending on what those circumstances are for you. We're going to go through application, renewal, tax returns. A little bit of that information is all going to go into your student loan repayment strategy. And no matter which way you decide to pay back your student loans, there's going to be side effects, right? Whether you try to pay your loans back as fast as possible, or you take an income-driven approach, or something in between, all of those are going to have some kind of side effect associated with them. Just like anytime we treat any of our patients, usually there's going to be some kind of side effect, either because of the drugs we're using or because of the condition that we're dealing with, right? So we want to be able to identify those, manage them appropriately, and make sure that you're doing all of the right things to keep you on track with your finances and your student debt. And then we'll finish up thinking beyond student loans, right? For most of you, I know this is the biggest expense that you've probably taken to date in your lifetime, and rightfully so. You are over focused on, doing something with that, right? But we want to make sure that you're not forgetting about all of the other things that you really should be doing, and all that are also way more important than just paying back your student loans. We do take a clinical approach to this, right? Because that's how your brains are wired, right? So we're going to do a physical exam and diagnostics of your information, and then we'll layer on some prescriptions and treatment plans based on what we find in there. Here are some of the comments that you guys made that we're going to cover tonight. So I want to pay back quickly to avoid high interest, but not at the expense of quality of life. Should I focus on saving, buying a home, paying back loans quickly? My favorite, paying loans until I'm dead. Why shouldn't I just pay it off ASAP? Right. So if you notice a little theme there, all of those have a speed component to them, right? Paying back loans quickly. I want to avoid interest. I don't want to be paying this for the rest of my life. And why can't I just pay them back as fast as possible? And you can do whatever you want, right? But it's really about what's the smartest way to pay back your student loans, right? Because we all have limited resources that we're dealing with. I wish that were not the case, but we're using student loans for a reason, right? And then now you're going to graduate and you're going to start having income associated with whatever you're going to do after graduation, and those resources are limited. So we want to make sure that we're using those resources in the smartest way possible. All right, so I've got a poll here that I'm going to fire up, and it's kind of related to these questions that are here. So this was also a comment that somebody submitted that I thought was a good one to see how it resonated with you all. So the comment is, I worry about my student debt hindering me from buying a house or starting a business. It will also force me to stay in the workforce until it is repaid, meaning I cannot take time off if I want to. All right, some great participation here. Excellent. 90+%. All right, let's see, let's share the results here. So kind of an even split, right? But also, somewhat strongly agree are the, kind of winning out, right? So I would say that kind of that maybe that fear and component of what your student loans are going to maybe prevent you from doing. Hopefully by the end of this session tonight, you're going to learn that your student loans will prevent you from doing nothing, right? Unless you let them. So none of those things that person is afraid of have to happen, right? But if you allow them to happen, then they can, right? So you have a choice in that matter, which is good. All right, so the changes and benefits, and some of you even commented about them, right? And so that's great, because that tells me that you're tuned in, right? And that you're paying attention to what these changes might be. One of them, that pay as you earn won't be available when you start repayment. And that's something we definitely want to be aware of. It's quite likely it will be, right? Because again, some of you are really close to graduating, and there hasn't been any announcement yet of when those changes are going to take effect. But we do want to be aware that pay as you earn is on the chopping block, right? So it could be phased out, and that's going to be important if that happens to be the best repayment strategy available to you. You want to make sure that you're using it before it does get phased out. As part of that phasing out of pay as you earn, the Biden administration is proposing to improve revised pay as you earn, right? So what this person is calling the new Biden repay, that would be the updated version of repay, which is going to be quite beneficial, right? But kind of related to this time component, repay will have you in repayment longer than a plan like pay as you earn, right? So we're going to have to balance that against the benefits of the updated version versus being in repayment for a shorter period of time. And for whatever reason, it's always interesting to see how these things ebb and flow over the years. But the last couple of years, particularly those of you that are graduating, post-pandemic here, you seem to be more focused on eliminating your student debt fast. Like time seems to be an element that comes up in a lot of comments. And if you have the resources to do that, great. But if not, then it may not make sense for you to race to that finish line, right? Because it's going to require too much of your resources to do so. And we're going to talk about all of those things, and then also the return of interest, right? So interest has been off, thankfully, for you all for almost the majority, if not all, of your education for veterinary school, which has been hugely beneficial. But at some point, this party is going to end, right? And everybody's interest rates are going to get turned back on, and we're going to be reintroduced to repayment for those of us that have had monthly payments turned off for a while too. So that's probably coming later this summer. All right, so just a little bit of background on myself and why I do this, right? So I'm a veterinarian, I'm married to a veterinarian, and both of us have a lot of student debt, right? And I'm kind of a career changer, number geek. I came to veterinary medicine from corporate finance and engineering, and I thought I was doing all of the right things to keep my student debt as low as possible. But my tuition went up a whole bunch while I was in school, and I married a veterinarian who had even more student debt than I did, right? So much for things going according to plan. But combined, we have more than $400,000 of student debt. And similar to what you all will face after you graduate, if you don't choose a different repayment plan, the automatic default plan that they'll put your loans in is called the standard 10-year plan. And that's a time-driven plan that calculates your monthly payment based on the principal, the interest rate, and the amount of time it takes to pay that balance to zero. Right. So at $400,000 of student debt at a roughly 6.6% interest rate, it would have been a monthly payment of $4,500 per month for us. Right. And we weren't earning $4,500 a month at that time. So there was no way we could even choose that if we wanted to. Right. So we had to extend our repayment beyond 10 years just to be able to make the minimum. Stumble upon these income-driven repayment plans. Right. So as the name implies, your payment is a function of your income. Right. So when your income's lower as you're getting started, your payment will be lower. As your income increases, your payments will increase. Right. But it's the same percentage of your taxable income. Right. So we started out using a plan called income-based repayment, the older version. Right. And that got our payment down to $1,400 a month. And a few years after we graduated, revised pay-as-you-earn was added, right? So these plans changed. They've changed in the past. They're set to change again. But Repay came online in 2015, and we crunched the numbers and decided that it was going to make more sense for us to move from IVR to revised pay-as-you-earn, and that got our payment down to $930 per month. Now, with the pandemic forbearance benefits that started back in March of 2020, we haven't had to make any payments. We don't have any interest accruing. And the way that income-driven plans work is you make payments for a specified period of time. And if you still have a balance remaining at the maximum repayment period, right? So Repay has a maximum repayment period of 25 years, right? Then that remaining balance is forgiven. And we may have to pay tax on that. Now, the pandemic forbearance benefits still keeps that forgiveness clock ticking, even though we haven't had to make any payments for more than 3 years now. So that has been extremely beneficial for those of us like myself and my wife who are using an income-driven repayment strategy, right? Our balance hasn't changed. We haven't had to make any payments, and we've fast forwarded our forgiveness timeline essentially by 3 years, right? So that has been hugely beneficial to our overall financial goals, as well as our student loan repayment goals. All right, so I mentioned the forgiveness, right? That's one of the ugly side effects of these income-driven repayment plans. But if you manage it or you're forward-thinking enough, it can actually help you decrease the overall cost of repayment. So we're planning and saving for forgiveness. We're about 80% to our projected forgiveness tax target with about 14 years to go, right? So what that means is we're ahead of schedule, right? So here is a snapshot of what our forgiveness plan looks like. Right, so we use a platform called Wealthfront. It is a robo-advisor, and there's dozens of these out there. I like Wealthfront just because it's super easy and it lets me contribute weekly to our forgiveness fund, and not a lot of those will allow you the option to do that. But essentially what this is showing is a dotted line, which represents the amounts that we've contributed to this fund. And then the solid line, which is the actual value of this particular investment, right? And this is a combination, diversified combination of low cost exchange traded funds, otherwise known as ETFs, right? So it doesn't cost us very much and it gives us exposure to stocks, bonds, across the world. And we can watch that investment grow over time, right? So kind of like your retirement savings follow a similar path, right? The longer you have them invested, generally the trend is upward, as you're seeing here, right? And the bigger the difference between the dotted line and the solid line, when it comes to my forgiveness fund, the less of my own money is actually going towards paying that tax, right? So I've got 14 more years to watch this pan out. And this thing is actually pretty much on autopilot right now, right? So the dividends alone that get paid out monthly, quarterly, depending on the fund, will satisfy this fund enough to reach my projected forgiveness target 14 years from now. But I still do contribute a small amount every week just because I think that dollar cost averaging is a good thing, right? So I think it helps me in the long run to smooth out some of this variability that you see inevitably with any kind of investment like this. Can you spell out what this is called? So the one, yeah, sure. The one I use is called Wealthfront, right? And there's literally dozens of these out there, right? So Betterment is another popular one. There's one called Ellevest, ELLVEST. I mean, Vanguard, Charles Schwab, a lot of the investment banks have these types of options available for you to start investing. You can even use it for your retirement plans if you want to do so. But we use this as our dedicated forgiveness planning fund, right? That's another key component of this. I don't want to lump all of this in with my other investments, right? And I certainly don't want to use my retirement savings to cover my forgiveness tax if I have to pay it, right? Because those things should not mix, right? My retirement savings are for retirement, right? So I can actually think about retiring someday, right? It's not so I can, decrease my ability to retire so I can pay a tax on my student loans. So I want to have a separate dedicated forgiveness fund. So this does bring up an interesting concept, though, that I want you guys to think about. So there's another comment that came in as part of the Sigma form submissions, but this person says, I would like to pay an amount that covers the interest so that the principal can come down to decrease the income tax amount on what is forgiven, right? And that's not a real good idea, right? I don't pay more than the minimum, right? So I just kind of told you that I haven't had to make any payments for 3 years, and I haven't. There was no good reason to do that. We've actually boosted the forgiveness fund instead, right? And so why don't I pay more? Or in this case, why don't I just cash this out and make a lump sum payment to our student loans, right? So I told you I have about $400,000 of student debt. Let's pretend that there's $100,000 in this forgiveness fund. Why don't I just cash out that $100,000 and put it towards our student loans, reducing it to $300,000, right? Why isn't that a good idea? And feel free to type, any thoughts you might have in the chat on that. Right, because this comes up a lot. I see this on the student debt message boards all the time, right? Especially as your payments are low or to zero, as they've been for us for a few years. People are like, oh, well, I'm going to put some whatever extra funds I have towards my student loans, and I'm going to knock down the principal. And unfortunately, I'm not, I wouldn't be able to knock down the principal because we also have interest that the payments would go to first, but I would still also have $300,000 in student debt remaining if I cash this out, right? And I wouldn't change my monthly payment even when repayment starts back up because my payment is based on my income, right? So even if I knock the balance down by $100,000, my payment is still going to be the same. And it's still quite likely that I'm going to hit forgiveness. I'll have a lower amount forgiven, but I got to start the whole forgiveness planning fund thing all over again. And I just voluntarily paid more towards my student loans than I have to, right? So it doesn't, if you're projected to hit forgiveness, then it doesn't make sense for you to pay more than your income requires, right? You'll just end up voluntarily paying more, right? The hard part is knowing whether or not you're going to reach forgiveness, right? That's the hardest part, but that's what we're going to use. I will show you some tools, how you can do a physical exam on your student loans, how you can send that information over to the VIN Foundation Student Loan Repayment Simulator, and do some best guessing and see what the likelihood is that you're going to reach forgiveness. And that's exactly right. Andrew put it in there. You're paying cents on the dollar for the forgiveness tax, right? Does anybody know what the top federal tax bracket is in the US? %40%. It's actually lower than that, 37, right? So my worst case scenario, presuming those tax brackets stay the same, right, is that I'm going to pay 37 cents on the dollar of what's remaining of my student debt, right? So great question here. How do we know that the government will keep this forgiveness plan in 20 years? Yeah, so it's baked into your student loan contract, right? It's baked into the master promissory note that you signed when you took the student loans. Right now, so they can change the specifics, right? They've added plans. They're talking about phasing one out and improving another one, but they can't touch the forgiveness provision because it's actually law, right? So they're unwilling and highly unlikely to change that law for people who are actually in the midst of working under those contracts, right? So they don't propose to eliminate forgiveness. They have proposed to create another type of student loan that might not be eligible for forgiveness, but that's not going to apply to you. That would apply to somebody behind you that would sign a different master promissory note or a different contract for those different types of student loan. Right, so the big variables when it comes to forgiveness and student loans is what that tax is going to be, right? And then kind of these details that change with the repayment options that are eligible for forgiveness, right? Those are the things that are more likely to change and have changed over time. And actually, one of the things that we've seen recently is that the any student debt that's forgiven between 2021 and 2025 is tax-free, right? So Congress passed that law in 2021 during the pandemic, right? So anybody who receives student loan forgiveness between now and 2025 won't have to pay any tax on it. And that opens the door for that potential provision to be extended into the future as well, right? But because my projected forgiveness is going to be in 2037, it's outside of that tax exempt window. I still have to plan as if I'm going to pay that tax, right? So that's the overarching way that this works, right? So just wanted to set the stage, just kind of show you how the approach that we've taken, but it has been superbly successful and better than I can anticipate it, right? So it has allowed us to build a robust financial wellness strategy, buy a home, have some investment, have some other ventures on the side, have our first daughter, which took a lot of IVF and which was extremely expensive, right? So there's a lot of reasons why you don't want to throw all of your available resources towards your student loans when there's so many better things that you can do with your money, right? As long as you're managing your student loans appropriately along the way. So how do you get this started, right? So some of you found this out. Others, I noticed that you submitted your signalment forms or you'll get stuck in the part of the signalment form where I ask you to submit your student aid data file. I want to show you where that is, right? So everybody knows, because this is something that you're going to want to do on a pretty regular basis, right? Just like an annual physical exam, you're going to want to check in on your student loans at least annually, maybe even more frequently because of all the changes that have been coming down and announced recently. So everybody should be pretty familiar with this. This is, where you applied for your student loans, but this is also where you're going to go to apply for repayments and renew your income documentation and find that student aid data file. All right, so I'm going to log in here with my credentials. They've got this new phone security system now. Thankfully, it's pretty fast. So I would encourage you guys to kind of go through and do this if you haven't already, right? So while I'm kind of logging in here and showing you where that file is, do the same, right? Especially at some point here, do the same to see what you see when you log in. You can see this is the share of my student loan balance. So I've got a little bit less than half of the household student loan balance. I mentioned before, I have unpaid interest, right? So this is one of those side effects of income-driven repayment. You can have a payment that's less than the interest that accrues, and it accrues separately as what's called unpaid interest, right? So, but that may be going away. That's one of the changes that the new version of repay would eliminate essentially unpaid interest. If my payment was below the monthly interest, the government covers the rest, right? So I would not accrue any unpaid interest with repay only, right? Only repay has that feature. We're going to cover that a little bit later. All right, so this isn't enough information for me to make any decisions, so I have to hit this view details button. And it's going to take me to this dashboard page in the federal student aid universe. And I'm looking for this download my aid data. That's what's going to produce your details, all of the hairy, ugly details of your entire higher education U.S. federal student loan borrowing career, right? So that you're going to need that, right? Because all of that information is really important. It's going to become even more important with the changes that have been proposed to the income-driven repayment plans. Right, so click that download my aid data button, and it's going to generate this ugly looking text file .txt. Save that to your computer somewhere, right? And then I'll show you what you can do with that in just a second, right? But that's the file that you're looking for. All right. So I just a question here. What are the chances of the new plan passing? All unpaid interest coverage seems like it would get shut down immediately. Yeah, so that doesn't have to pass, right? That is actually in process, right? So it's already, that is a regulatory change, right? So that is a change. The executive branch has the ability to change how the existing law is interpreted, right? So they are going to essentially reinterpret repay, right, under the law that governs the income-driven repayment plans currently, right? So, and the way that they do that is they propose these changes, and it gets it gets announced, and everybody gets to put their comments in and say this sucks or this is great. And in case they missed anything, they might tweak it, but they've already gone through that step of the process. So it's just a matter of time before they say, okay, these changes will take effect July 1st or August 30th, or maybe January 1st, 2024, right? So we're just waiting on when those changes will take effect and if they made any tweaks based on the public comment period, right? So this is how they created repay. This is how they created pay. This is going to happen. It's just a matter of when, right? So, and it's probably going to be, sometime later this summer or maybe early next year. All right, so I'll come back to where we're going to show you, or where you can put that student aid data file in just a second. All right, but what you're going to find in there, or some of the things that you may already be familiar with, are your loan types, right? So these are all the different federal student loan types. Most of you have direct unsubsidized or direct Grad Plus loans. If you had loans from undergrad, you might have some subsidized loans. If you were in higher education, like I was, anytime before July 1st of 2010, then you'll have these older federal family education loans. This is kind of the precursor to the direct loan program, right? Again, you can kind of see how this stuff changes, right, over time. But if you have these federal family education loans, you want to know that, right? So definitely you'll see that in your file. Those will show up as FFEL loans in that data file. Perkins loans, I still see those floating around. That was discontinued in that plan, or program was discontinued in 2018. Health profession student loans, loans for disadvantaged students, also types of loans you're able to take for veterinary school. They won't show up in the file, right? But it's a good idea to know if you have those or not. And then the ever problematic Parent Plus loans, right? So Parent Plus loans are only available to parents, right? So your parents may have used them to help pay for some of your undergraduate education, or if you have children of your own that are of college age, you may be using Parent Plus loans to pay for their college, right? But the person who benefits from them won't find those loans in their student aid data file. For example, if your parents use those to pay for your education, your parents are going to have their own student aid data file. Those loans will not be in your file, nor is there any way to get them into your file. Right, so that those loans tend to be problematic, and somebody was asking me about those as part of the submission for this new grad playbook, and I'll talk about that in just a second. Anything that isn't in that file and isn't a health profession student loan or a loans for disadvantaged student is probably a private loan. Right, these are going to be loans from like Discover or Sallie Mae, Wells Fargo, some other bank that offers private student loans. This is a breakdown of the last 3 classes of data that we have that we did the new grad playbook for, and this is pretty typical, right? So the majority are these U.S. federal student loans. About 20% of folks carry these health profession student loans, a smaller percent with the loans for disadvantaged students. Here's these parent plus loans, right? And in 99% of the time, these are loans that your parents took out for you, right? Private student loans are a little bit less than 10%. Family student loans, all of these others over here, these are almost always exclusively grad plus loans, right? Because you guys have to submit a separate application for them. You tend to think they're a different type of loan, but they really belong in this purple box, right? Those grad plus loans are a type of U.S. federal student loan, direct loan. All right, so good news, federal student loans, and this is why it doesn't always make sense to aggressively pay off your student loans. Your federal student loans are the most flexible and least risky debt that you're ever going to have, right? So if I'm going to prioritize where my funds go, I'm going to look for opportunities and more risky elements of my balance sheet to pay down first before I get to my student loans, right? So that's going to be a theme that pops up over and over tonight. I see a question here. Is there a dashboard only for certain servicers? I have always accessed my loan information via my servicer website, so I've actually never used that federal student aid website. Great question. Yeah, everybody here, this is a good time for an example here, and this is perfect timing, right? So you've got that student aid data file, go in there and download it, and I'm going to show you where you can put it next and why you should do that instead of using your loan servicer website, right? So this is going to be the first tool that we introduce you to, this VIN Foundation Student Debt Center. This is publicly available. You don't have to be a VIN member to use this. Anyone can use it, but it's designed specifically for veterinarians and veterinary students. Now, you guys are all knocking on the door here, and because the pandemic forbearance benefits are in effect, you're not going to accrue any more interest between now and when you graduate, most likely, right? Except if any of you are going to graduate beyond August, then you may accrue a little bit of interest. But let's, for the time being, assume that you're not going to accrue any more interest between now and when you graduate. I'm going to click this, I have graduated from veterinary school, and I'll upload one of the examples that I have here this evening. Right, and so the reason you want to go get that student aid data file is because the loan servicer websites are inconsistent, right? So there's a handful of loan servicers and they all show different information in different ways. And that may not be all that important while you're a student and still borrowing, but when you get to repayment, it's going to matter, right? And those loan servicers don't show you the nitty-gritty details that you're going to need to help make decisions on which repayment plan is best for you. Right, I have not seen a really good loan servicer website that will show you which plans you're eligible for. They'll talk about all of the plans and they'll leave it up to you to figure out which one you're eligible for, right? And sometimes you'll actually say, I want to use this one, and they'll say, well, you're not eligible, right? And you may not think that's right, but you don't have another way of proving that. This is the way to prove that, right? So that student aid data file from the federal student aid website is the most consistent source of information on your student loan details. It's the same for everybody, right? So we can pick through that, which is why we developed this My Student Loans tool to show you the most important elements that you need to make informed student loan repayment decisions. And it also works as a really good check against your loan servicers, because you'll be amazed. They're going to be one of the most frustrating elements of repayment, right? They will tell you stuff that's not true all of the time. And you're going to need a way to know how to evaluate that, right? And if if your spidey sense is kind of going up, then you're going to have to ask question, post on the message boards, or reach out and confirm that, and then we can show you how you can approach them to get them to do what it is that should be done for your student loan. All right, so let's use this as an example. All right, so we've got 14 different loans. We've got $179,000 in principal. Unpaid interest is $1,000. Really, really low, because the interest rates have been shut off for almost the entire time you guys have been in school. Right? Under a normal set of circumstances, this would probably be, I don't know, somewhere between $17,000 and $20,000 for this person, based on how much they borrowed. Right? So this has been tens of thousands of dollars in savings by turning those interest rates off. Now they're going to turn them back on, right? And all of these loans, if you hit the show details button, have different interest rates, right? So it can be difficult. This is where the analysis paralysis starts to show up. I look at all these different numbers, all these different interest rates, and I just start throwing money at places that may or may not be helpful. Right? So we try to give you a weighted average interest rate so you can treat this as if it were a single loan, show you how much interest is going to accrue on that particular balance. Right? And also, probably the most important feature in here is the income-driven repayment eligibility tab. Right? So you could choose any plan that you want, but the income-driven plans have some really bizarre qualification requirements, right? And they don't make a lot of sense, but they're strictly based on the loan types you have and when you started borrowing, right? So we have those algorithms worked out in here. We can see here that this person is eligible for the old version of IBR. That's the plan my wife and I started using. But they're also eligible for pay-as-you-earn, right? As we alluded to in the beginning, that's on the chopping block, right? But it's currently still available, right? So if you can graduate and it's still available, this person could choose that plan. And then also revise pay-as-you-earn, which we said is going to undergo some changes. Now, one of the I guess old rules that still apply until the new changes take effect is that pay-as-you-earn was one of the most beneficial repayment options available for any veterinarian. Right? It was the most flexible, it had the shortest time to forgiveness, 20 years, right, versus 25 years for prepay and the old version of IBR. Right, so pay-as-you-earn worked quite well. Now, if they eliminate that and you're not eligible for the new version of IBR, which is very similar to pay-as-you-earn, then you could be looking at a longer duration of repayment. Right, so looking at this one and just knowing what we know about the proposed changes and which plans this person is eligible for, if they graduate and those changes haven't taken effect yet, they're going to really want to consider using pay-as-you-earn, right? Because if you're in it before the changes take effect, you can keep using it, right? You're essentially grandfathered into that plan, right? But if you can't get into it because the changes took effect before you graduated, or you waited too long to choose it, you won't be able to choose it again, right? So this is one of those things I used to always look and see, are you eligible for pay-as-you-earn? I didn't really care about income-based repayment 2014, the new version, but now I do. Because if you don't have access to this, right, this is another good option that gives you 20 years until you reach forgiveness, right? So you want to check which income-driven plan you're eligible to use. Great question. What if you have 98% eligibility? That means that you have another loan type in here that isn't a direct loan, right? It's probably a Perkins loan, right? So I would check this loan type tab, right? And look and see what kind of loan that you have in there, right? If you have health profession student loans, right? So I have another example. Let's do another one of a person that has health profession student loans and loans for disadvantaged students. Right. Again, those don't show up in the file, right? So, but we have a way for you to add those into this My Student Loan Summary, and it'll illustrate that different percent eligibility. It just means that you don't have all direct loans, and that's okay. That you can fix that after you graduate using a consolidation loan, right? So that's one of those things that you want to identify and look for. Or I guess it could be a small Bell program balance too, of one of those FFELs if you had borrowed before 2010, those could also be in that particular data file. But based on what you're saying there, I'm guessing that's probably a Perkins loan. But that's exactly what I want you guys to do. Grab that file and check and ask those questions like while we're sitting here, right? So that's a great idea. So this person has a lower student loan balance, right? But they also have health profession student loans, right? And they have about $49,000 of health profession student loans, which is great. They have low interest rate and they don't accrue interest even when the pandemic forbearance benefits are not in place. And let's just put Heartland because they tend to be the loan servicer for those types of loans. Right, and they also have about 10,500 of loans for disadvantaged students. We'll add that in, and it'll add it to what we found in the file, right? So it'll total up everything. It'll recalculate the weighted average interest rate, but you'll also see down here, we've got a new category, other federal student loans. Here's those health profession student loans, loans for disadvantaged students. When I check that income-driven repayment eligibility, I'm going to see a percentage that's less than 100, right? Because only direct loans are eligible for most of these income-driven repayment plans. But if you have those other federal student loan types and you consolidate them into a direct consolidation loan, they will be direct loans, and 100% of that new consolidation loan will be eligible for these same plans. Right now, this is a good example. This person is eligible for the new version of IVR. Right, so that's a good thing in terms of the changes that are about to come down the pike here sometime in the not so distant future. All right, so how soon after graduation can we choose a plan? Well, it depends on what you do with your student loans, right? So if you graduate and consolidate, you have the option of ending your grace period early, right? But you have to be done with school, right? So you're really looking for your direct, here, let's see, let's come back to this example. I'm looking for these direct unsubsidized loans. You see how here they say in school? When that loan type says in grace or grace period, that's when you can start that consolidation loan. I know if you don't consolidate, you have to wait until the grace period expires, which is 6 months after you graduate. Right? They won't let you apply for a repayment plan until you're approaching the end of that grace period, right? Which is what makes consolidation compelling in most cases. And we're going to get to that in just a few minutes. All right, so we've covered a lot of these special benefits just to kind of put a bow on those, right? So the pandemic forbearance benefits started in March 13th of 2020. They're probably going to last through August. Right? It depends on when the Supreme Court actually decides on the special cancellation benefits that they heard the case on this past February, right? So when the Supreme Court actually decides yay or nay, you can cancel 10,000 or 20,000 depending on your income and whether or not you received a Pell Grant. Loan repayment will start 60 days after that, right? And if they, if it gets to a point where it's I think June 30th, then they're just going to start repayment back up 60 days after that, which is this August 30th kind of longest possible day, right? So it'll probably be August 30th. It might be a couple of weeks before then, depending on when that Supreme Court decision comes out, right? But that's what we're looking at in terms of having interest and payments start back up again. If you made payments during this time frame, you can request a refund of those payments. Right. So I do see sometimes fourth years making payments as they're kind of, heading out the door with any available funds that they might have left. Right. I would discourage you from that. Right. Particularly if you've got to move and, you've got some credit card debt or you want to jumpstart your financial wellness and put down that first and last month rent for that apartment that you're going to secure after graduating, leave the student loans alone. Right. You're going to have plenty of time to deal with them later. You may want to get back some of those payments that you've made towards your student loans since March 13th of 2020. You can request that from your loan servicer. So I would highly recommend, keeping that money in your control, not making payments on those student loans. Consolidating, particularly for your class, is a good idea because you don't have very much unpaid interest. Right, because one of the side effects of consolidation is they're going to capitalize or take that interest and add it to your principal. But most of you have very little, if no, unpaid interest at all, so it's not such a big deal. right? But you can use that remaining time before repayment starts to jumpstart your financial wellness. So these changes, what do these changes look like, right? So if and when, well, they will take effect, it's just a matter of when, they're going to phase out pay-as-you-earn, the older version, the original income-driven repayment, ICR, which nobody uses because it's a pretty terrible repayment option. And then they're going to update revised pay-as-you-earn. Right? Anybody who's using these plans when those changes take effect will still be able to use them. The updates to repay are going to decrease your monthly payment overall, right? And they also come with this 100% unpaid interest subsidy. Right? So what does that mean? It means that if you're accruing $1,000 a month of interest and your monthly payment due is $500, you're $500 short, the government will cover the remaining $500. Right now, Repay has a 50% unpaid interest subsidy. So in that same example, if you're $500 short of the interest each month, the government's covering $250 of that. The other exciting change for Repay is that when you're married, you will have the option of excluding your spouse's income if you file a tax return that's separate as the most recent tax return. Right? The current version of Repay doesn't allow that. Right? Married borrowers, even if they file a separate tax return, have to provide both your income and your spouse's income to calculate the payment. Right? All of the other income-driven plans let you separate your spouse's income if you file your tax return separately, except for Repay. So they're changing that to make it more like the other ones. All right. So one of the other things that, and I've already kind of alluded to this, capitalization is one of those things that can happen to your unpaid interest, right? So you have a variety of reasons why you might have unpaid interest on your student loan, right? You accrued interest during school, right? We showed that in one of these examples, right? This person actually doesn't have any unpaid interest because they have very low balance, and those loans for disadvantaged students and health profession student loans don't accrue interest during school. This person actually has a small amount of unpaid interest, right? This was probably on those loans that they received before the pandemic forbearance benefits kicked in, right? And the normal state of affairs used to be that interest accrued on direct loans during school, right? So this interest will get added to this principal balance, resulting in a new principal balance on the consolidation loan if this person consolidated of $180,558. As of July 1st, they're going to start to eliminate some of the reasons for unpaid interest capitalization. So if you just let your grace period expire, they won't capitalize your interest, but you have to wait for your grace period to expire, and that might not be a good thing. If you're switching from a plan like IBR or you're using deferment, those will result in capitalization. Consolidation will still result in capitalization, right? But again, you guys don't have a lot of interest to worry about capitalizing when it comes to consolidation. That's a real benefit of the 2023 graduating class and those pandemic forbearance benefits. But you will have, before, if you switched between repayment plans, you would get hit with this unpaid interest capitalization. Like when my wife and I switched from the original version of IBR over to Repay, we had our interest capitalized. Right now, if we were to switch from Repay to some other plan, our unpaid interest would not capitalize. Right. So overall, that's a good thing. But there's still some instances where they cannot disallow that capitalization of unpaid interest. And then think about the difference, right? So capitalization is not the same thing as compounding. This is another one of those misconceptions around student loans, is that you got to pay them back fast because the interest is compounding, and your interest doesn't compound. Right? It can capitalize, which means it can get added to your principal once or twice, 3 times, depending on what you're doing or not doing correctly with your student loans, right? But it's not compounding. Compounding would be that your interest is added to your principal continually, right? And that does not happen. That's one of the benefits of your federal student loan. Okay, one of the other ones that we need to mention, and this is particularly important for those of you that may have some older loans from before veterinary school that were in repayment before you started veterinary school. Right? So there's a really unique opportunity, and this is most beneficial for people who have a lot of older loans that have been in repayment for a really long time. But one of the really frustrating aspects of student loan repayment is the duration that you spend in repayment. Now, one of the announcements that the Biden administration made about a year ago was that they're going to count any repayment time as forgiveness eligible. Right? So you can think about this in terms of those older loans that you might have from before veterinary school, right, that have some repayment time, right, that would be eligible for forgiveness time. And if you consolidate those with your veterinary school loans, there's a really good chance that you'll transfer some of that repayment time over to your consolidation loan, which means that you'll impart some forgiveness eligible time to your veterinary school loans and shorten the amount of time that you could be in repayment. Right? But in order to do that, you're going to need to consolidate your loans. Right? So maybe you're hearing a theme here is that consolidation is actually pretty beneficial, right? In the majority of cases. Right? And right now, particularly now through the end of this year, if you've got older loans that have some repayment time, you may even steal some of that repayment time and put it on your veterinary school loans, which would shorten your time to forgiveness if you reach forgiveness. Right? And this is called the one-time forgiveness count adjustment. Right? We've got a blog post on that that goes through the details of it. Right? But if you have some older loans that have some repayment time, I would highly encourage you to consolidate your loans as soon as you can after you graduate. All right, let me get back to some questions here. Do I have to eliminate those loans to qualify? So keep it, this is, you were asking, I believe you saw that 98% of your loans were eligible in that income driven repayment eligibility tab. You don't have to eliminate them, you consolidate them, right? You can consolidate them into a direct consolidation loan, and then 100% of that consolidated balance will be eligible for the repayment plans in that income driven repayment eligibility tab. Is there a way to add a spouse's income to determine if we are eligible for these repayment plans? Absolutely. That's going to be the low repayment stimulator. We're going to cover that in this next part of the in the next part of the webinar here. If I do pay as you earn now to grandfather in, can I transfer to repay without restarting my forgiveness? Yeah, but you're going to want to do the other way around, right? So you can switch from one plan to another and it doesn't restart the clock, right? So that whatever repayment time, forgiveness time that you had with one plan will transfer to another plan, right? But you probably don't want to switch from pay as you earn to revised pay as you earn, right? Pay as you earn has a shorter time to forgiveness, right? So if anything, you want to start with revised pay as you earn to benefit from the unpaid interest subsidy and then switch to pay as you earn before it gets phased out. So you can have the shorter time to repayment, right? Now that only applies if you're not eligible for the new version of IBR, right? Which we illustrated in our example here, right? So this particular person is not eligible for the new version of IBR, which means if they're not using pay as you earn when it's phased out, then they'll lose access to it. And generally speaking, the duration of time to forgiveness is kind of the king, right? The shorter that time frame, not only will you be done with repayment sooner, but you're going to pay less, right? So this is why that phased out of pay as you earn is kind of problematic in this particular case. And there's a number of you graduating this year that are going to fall into this, let's call it hole, right? Where, you know, depending on when they phase out pay as you earn, you guys may get lucky, right? Because it's highly unlikely they're going to phase this out before you graduate, right? So you're going to have a chance to get into pay as you earn, right? The folks behind you won't, right? Because it's probably going to take effect again later this summer or next year, right? But you really want to see, am I eligible for the new version of IBR, right? Essentially, was the first loan that I received after July 1st of 2014. If I had a loan before then, I'm not going to be eligible for IBR 2014, right? I want to be really aware of pay as you earn and when those changes might take effect. All right, so I'm seeing a lot of questions here about what happens immediately after graduation, and that's kind of where we're headed next. So great question. Why didn't you do pay as you earn as opposed to revised pay as you earn? Because I'm not eligible for it, right? My wife and I are not eligible for pay as you earn, right? We did not meet these requirements, right? And that was a problem for my cohort of graduating folks, right? Those of us that graduated 2012, 13 and before didn't really have access to pay as you earn, right? That's really available to folks that graduated 2012 and after, depending on when you started borrowing, right? So that's why. Otherwise, that would have, right? Pay as you earn would have been the best option for us, but we're not eligible for it, right? So the next best option for us is revised pay as you earn. All right. Oh, one of the other things I wanted to show you. So to get help, right? So when you upload your student aid data file in here, you'll see here that I'm logged in, right? And I use my VIN username and password for this. So even if you don't continue your VIN membership after you graduate, right? You can still use your username and password to log in to the Student Debt Center, right? Which lets you save these files in here, right? And it'll give you a link to the student debt message board area. Right. So what's the student debt message board area? So some of you, especially you fourth years, are probably using the message boards more frequently on clinics, right? To help understand what's going on with those cases that you're seeing, right? But we kind of applied that same concept to student debt, right? So there are thousands of our colleagues who have posted or are posting their student debt and income signalments to get assistance on their student loan repayment question. Right? So we put some of these already for those of you that submitted and requested this as part of the signalment form submission already on here. Right? So that you can post anonymously. We post a summary of the information in the signalment form, right? Because all of that information is going to be relevant in terms of what we talk about in terms of should you consolidate? When should you consolidate? Which repayment options are you eligible for? Based on your debt to income ratio, which most likely to be the best repayment option for you, right? How do we account for your goals and financial plans to make this all work, right? And then you can return here as you are doing whatever it is you're going to do after graduation, right? Maybe I'm going to do an internship and then start private practice, or I'm going to do internship or residency, or I'm going straight into practice. I'm going to get married in 2 years. I'm going to have a kid. How is that all going to impact my student loan repayment strategy? That's where the message boards come in, right? You come back here, post an update, and we'll see if there's a reason for you to switch gears away from your repayment strategy. Right? So this is really the secret sauce of this. Right, is where we learn all of this information that we can distill down into those best practices that we can give back to you as part of this new grad playbook, right? So take advantage of that if you have questions, beyond tonight, or you want to get some clarification on your specific circumstances.
Yeah, and just a quick note there for anybody that is waiting to get a response to those message boards. We are working our way through. We've had quite an influx here recently with the playbook and some of the other news that's going on, but we're working hard on those.
Absolutely. All right, so I got another poll question for you. What is the most important thing, before we get into this next section, what is the most important thing you can do before graduation to help with your student loans?
It's very tricky how you post a photo of a fish with the question money. Very well played.
Yeah, well, that's what I would have done, is gone fly fishing. But the correct answer is that you guys have all nailed it, is file a tax return. Right? It's never wrong to go fly fishing, right? But file the tax return first. Those of you, I saw there was a number of you guys that are at Colorado State. Do any of you guys know what this is? This is one of your home fish. I caught this in the Blue River, which is not too far from you all over there in Fort Collins. Yeah, it's a cut bow. It's a combination of a cutthroat and a rainbow. You can see kind of the flash here under the gill that kind of makes it one of those hybrid that we'll find in a lot of the rivers around here. Cool, but filing a tax return is the most important thing you can do, right? So, and we're going to tell you why in the next part of this session. All right, so also start thinking about what your debt to income ratio is, right? What is my student debt balance? You guys should all know what that is based on that student aid data file exercise we went through. And then most of you are going to know what your income is after graduation. Right, so take that student debt, divide it by your income. What number is that? Right, and based on running thousands and thousands of simulations for our colleagues, some themes will arrive, right? And this is where the data points come from. If your starting debt to income ratio is less than 1, then you're going to pay your student loans off before you reach forgiveness, right? You don't have to worry about forgiveness. You can still use the income-driven plans strategically to keep your payments low, maybe even have the government cover your interest while you're doing an internship or getting started in your career before your income increases, and then pay your loans to zero faster as your income increases, right? Or you could use a standard 10-year plan, right, and pay above that minimum if you want, right? That debt to income ratio less than 1 is really flexible, right? The world's your oyster there. You've got a lot of different options. You don't have to worry about any of the forgiveness stuff. If your starting debt to income ratio is greater than 2, then these income-driven plans are going to be your best friend, right? Not only are they going to keep your payments low, but they're also going to be the lowest total repayment cost option for you as well, right? And this is where some of these newer strategies are going to come into play, right? So starting with pay as you earn, if you're not eligible for the new version of IBR, or if you are, you start with revised pay as you earn and then switch to the new version of IBR later on down the line. And that will actually produce probably the lowest repayment option available if you have income-based repayment 2014 as an option for you, right? You'll pay the minimum required by your income. You'll plan for that potential tax on forgiveness. And as your circumstances change, you'll reassess and see if you're still on the right pathway. If you're in between 1 and 2, then get started with an income-driven plan, right? And see where your debt to income ratio lands a year from now, 2 years from now, 5 years from now, and reassess then. But you can still benefit from particularly that unpaid interest subsidy with revised pay as you earn, even if your debt to income ratio is between 1 and 2. So yeah, this is kind of the new, this is whereas pay as you earn used to be the, graduate, consolidate, choose pay as you earn. Now the new recommendation is going to be check and see if you're eligible for the new version of IBR. For you guys, graduate, consolidate, start with revised pay as you earn, and then switch to IBR 2014 later on. So you can get the shorter duration of forgiveness, but benefit from the unpaid interest subsidy that Repay provides while your income is lower. All right, so just to kind of drive that point home, the higher your debt to income ratio, the more financially favorable these income-driven plans are, particularly that switching strategy from revised pay as you earn to the new version of IBR. The lower your debt to income ratio, the more it favors starting with Repay and then moving towards a standard 10-year or just staying in Repay until you pay off your student loans. So again, I've had a number of people kind of question these debt to income ratios recently. And of course, there are examples of, people who have debt to income ratios of 3, 4, 5 who pay their student loans to zero and don't use any income driven repayment. I don't think that's particularly smart, but you guys are going to have to make that decision on your own, right? But what is really driving these debt to income ratio recommendations? Right, and the question to answer there is, what does your taxable income need to be in order for your income-driven repayment, monthly payment, to equal a standard 10-year plan payment? Right, this is the reason why we have these income-driven plan payments, right? Because the cost of education has continued to increase. The default repayment plan is still the standard 10-year plan, and the way it was structured originally was we didn't want anybody paying more than 10% of their income towards their student loans. But as debt to income ratios got greater than 1, we started getting further and further away from 10% of your income being roughly equal to a standard 10-year monthly payment option. Right, so that's really what sets that debt to income ratio. When your debt to income ratio is 1 or less, your monthly payment using one of these income driven plan payments will be similar to a standard 10-year monthly plan payment. Therefore, you'd pay your balance to 0 in about 10 years. Right, but most veterinarians are graduating with debt to income ratios that are greater than 1, and nearly 40% of them greater than 2. Right, so that's the standard 10-year plan is not working very well for most graduating veterinarians. The other component of this is time, right? When might your debt to income ratio be less than 1? Right, so you know what it is now, right? As you're graduating, right? We want to pick up and look at it again next year, the year after your training, if you're doing an internship residency, or maybe after you've kind of settled on what practice type or location that you're going to be in, right? So that's going to bring me to poll 3 here. When do you think your annual income will exceed your student debt balance?
And Tony, while everybody's chiming in on that one there, could you go a little bit more into that sort of gray zone? So what if your debt to income ratio is like 1.5 to 1? Yeah,
so the debt to income ratio scale, it's almost like the Richter scale, right? So I think in the past people have looked at it like, oh, well, 1.5 is pretty close to 1, so that puts me in that debt to income ratio 1 scenario, and it's really not. If you're at 1.5, there's going to be a pretty significant difference between the standard 10-year monthly payment and what your repay payment's going to be, right? And when there's a significant enough difference there, you want to take advantage of that extra cash flow, right? Because you can use that to jumpstart your financial wellness and start increasing your overall financial wellness and wealth, right? So it's pretty sensitive, right? 1.5, 1.4, 1.3, those are still going to generate pretty significant differences between the income-driven plan option and a standard 10-year monthly payment option, right? So you have to just do that math and see what it is, which is why I generally lean towards that income-driven repayment, even if you're in that so-called gray zone.
Yeah, I think you can really see some of that in that loan repayment simulator results as well. So definitely play around with those.
Yep, absolutely. It all comes down to math, right? This is all just a really fancy math equation, right? And it changes constantly because your circumstances change constantly, right? And the options change a little bit here and there, right? So you're going to have to just keep doing the math to see which one is going to work best for you. Yeah, another great question I saw pop up in the chat. Is this for gross or net income? Neither, right? It's for your taxable income, right? And that's another thing that you guys are going to learn as you get out there and start earning and filing tax returns, is that, your net income is something different than your gross income, which is something different than your taxable income, right? And the income-driven plans use your taxable income or your adjusted gross income. If you're familiar with tax returns, you can pull that adjusted gross income line right from your tax return. All right, so here we have the result of the poll, right? So as soon as I start my first job, great. Within 2 years, 5 years, the farther you get out, the more likely it is you're going to reach forgiveness, right? The longer you're in an income-driven plan logging forgiveness eligible time, the more likely it is you're going to reach forgiveness, right? Even if your debt to income ratio dips below 1 5 years from now, or 7 years from now, or 10 years from now, you're still probably going to hit forgiveness, right? Unless you have a major increase, which can happen, right? Maybe you buy a practice, or you become a surgeon or a neurologist, or one of the really highly paid veterinarians in veterinary medicine right now, right? We can see that change, but generally speaking, the longer it takes for your debt to income ratio to get to 1 or less than 1, the more likely it is you're going to reach forgiveness, right? It just becomes a probability game, right? And if I'm likely to reach forgiveness, then I'm going to pay the minimum and plan for that tax because it's going to save me the most money and keep my payments as low as possible. All right, let's dive into consolidation here, right? Because this is the most convoluted aspect of this, right? Specifically with the changes that have been made. But again, if you're in doubt, consolidate, right? Because you guys are all in this really interesting situation where you've had almost no interest accrue during school. So even triggering the capitalization is not that big a deal. Now, in the future, it's going to be a bigger deal, right? So for the 2024, 2025, 2026 graduating classes, this is going to become a much more complicated math exercise to see if it makes sense to let my grace period run out or to consolidate and trigger the capitalization, right? Because that's one of the major differences is that consolidation now triggers, consolidation triggers capitalization, letting your grace period expire naturally does not. So now we've got some competing elements. But for those of you that have different loan types, right? So older loans, Perkins loans, health professional student loans, loans for disadvantaged students, or you have those loans that had some repayment time beforehand, you want to consolidate all of those, right? That's going to make things really easy, and it may even give you some bonus forgiveness time under this one-time forgiveness count adjustment, which again, your class is going to be one of the last graduating classes that actually have access to that, right? Because they're going to end that forgiveness count adjustment at the end of this year and then start applying it in 2024. Right, which means you guys are going to have that opportunity to consolidate and benefit from that if you have those older loans that have some repayment time. Loan servicers are not all created equal. Unfortunately, they all kind of suck, right? So this is my best attempt at the, you know, the loan servicer spectrum of terrible, right? So Advantage, god awful. Nelnet, terrible. Right? I'm really upset because I just found out last week that my loans are getting transferred from Great Lakes to Nelnet, which can happen, right? And that sucks because Nelnet sucks, right? And I just don't believe anything that they say, right? So I have to double check when they tell me, oh, you know, you're not eligible for this, that, or the other. And it's like, no, I am. Here are the rules. Please put me in this plan, right? So these two, you have to watch like a hawk, right? Great Lakes, not terrible, not great. Mohila, same thing. Now, Mohila, we recommend if you're going to consolidate, you could choose a loan servicer, right? And we recommend that you choose Mohila, not because they're good, but because they monitor public service loan forgiveness. And public service loan forgiveness requires you to use an income-driven repayment plan. And because most veterinarians can really benefit from an income-driven repayment plan, particularly immediately after graduation and for the early years, if not thereafter, choose the loan servicer that monitors public service loan forgiveness because they're going to have the most experience with the income-driven repayment plans. The consolidation process is the only opportunity you have to choose your loan servicer, right? So another reason why it's a good idea to consolidate. Probably the most beneficial reason is because it allows you to end that grace period early. And by end early, you want to select the do not delay processing option, right? You want them as soon as they consolidate your loans to put you in repayment because your grace period doesn't count towards forgiveness, but repayment does. And the only way you can end your grace period early is using a consolidation loan, right? So you can start logging that forgiveness time in case you need it, right? Because if I'm going to hit forgiveness, I want to hit forgiveness as fast as I can. So the cons of capitalization, so the cons of consolidation is capitalization. It's a pain in the butt, right? I mean, it's not terrible, but you're going to have to apply and then make sure that the application goes through correctly. And then you lose the option to target those loans individually, right? Which some people like to have. It's really not mathematically that beneficial. But I think all of these pros greatly outweigh these cons, particularly for your graduating class. All right, so let me show you how you can do this, right? So we're going to come back to that federal student aid website, right? So I'm gonna log back in here. Let's see if they're gonna make me do that code again. Wow, that's too bad. All right, this is. So you, again, log in, grab that file, upload it into My Student Loans tool so you can kind of see your loans. And if you want to add loans that aren't covered in there, like those health professional student loans, loans for disadvantaged students, it'll help give you an idea of what that consolidation will look like, right? But in here, you're looking for, under loan repayment, consolidate loans, right? And if you're logged in, it will pull all of the loans that it finds into your consolidation, right? So I'll start this here. I can only take you so far because my loans are already consolidated, right? But it'll still let me do enough of this to demonstrate it. So any loans that are in the file, in your file, it'll find automatically and add, right? Now you may have to add loans like health profession student loans, type Q down here, right? Or the loans for disadvantaged students, which is the, right? So you can add them electronically, but you have to add them manually, which means you're going to have to go find that account number for those, which is probably living with your school in the financial aid account you have with your school, or it might be with another loan servicer, right? But you can add those loans electronically and manually. Here's what I was talking about, the processing delay. Do not delay processing, right? You don't want to if you're going to consolidate, there's no reason to choose anything other than this do not delay processing. Like if anything that you choose here is just going to delay the start of your forgiveness clock, right? And if you end up reaching forgiveness, you want to reach it sooner rather than later. Loan servicer, if you check this box, it'll that you're going to be working for public service loan forgiveness. Doesn't mean that you will or have to. It just will make it more likely that they'll put your loans with MOHELA, who is the official monitor of public service loan forgiveness, right? But here's where you can select them, right? So choose MOHELA. And continue. And then this is where they're going to start asking you questions about your income, right? And this is really to determine your repayment plan amounts, right? So let's say you filed a tax return, right? This is why this is the most important thing you can do as a fourth-year veterinary student is file a tax return, because what's that number going to be? Probably something very close to zero, right? So if I put 0 in there and I'm a single person, right? My payments under these income-driven plans are going to be 0, right? Still counts towards forgiveness, right? I just don't have to make a payment, right? If I'm using a plan like Revised Pay As You Earn, the government's going to cover the interest once the interest gets turned back on.
And what if your parents claim you as a dependent on their taxes? Are you still able to file that tax return?
You are. You can still file a tax return even if your parents claim you as a dependent. Even if you don't have to file a tax return because you don't have any income, you can still voluntarily file a tax return, right? You just need a tax return that's tied to your name and social security number that has an adjusted gross income on it, so they can use that as the official documentation to get you started in an income-driven repayment plan. Right, so that's why it's important to have that tax return on file. It just opens up a lot of options for you to have a very low, if not 0, payment for the first 12 months of repayment, so you can focus on all of the other things that are be going on in your life, right? Moving, learning how to be a veterinarian, starting your internship, starting your job, right? Building your budget, saving for retirement, building an emergency fund, paying off credit card debt or other less flexible loans, right? All of those things are more important than paying more than you have to towards your student loan. And for most of you, you're not going to have to pay anything for your student loan. What if you already filed jointly with a spouse this year? So that's a problem, right? So for those of you that are married, if you file a joint return, then they're going to use the adjusted gross income from that return, which is most likely going to show your spouse's income on there, right? So you'll have to use that as to document that payment for those first 12 months. Now, you are still within the tax filing deadline, right? You can probably change that tax filing status to separately if it's not going to cost you too much to do so. But that's where you want to start doing some cost benefit analysis. Am I going to have a significantly enough lower payment by filing separately than the cost I'm going to incur by doing so? Right? Because in general, you're going to pay more if you file your taxes separately when you're married than if you pay jointly, but you'll also pay less towards your student loan. So you have to see which one's going to win. Consolidation will take, right now they're kind of back on the 30-day time frame. It can take 60 days or even more. This summer it was taking a long time, but they're kind of back to that 30-day flow now, which is good. So it happens pretty quickly. And if you forgot to add a loan, you have 180 days from the time that your consolidation completes to add additional loans to that same consolidation without having to start that whole process over again. All right, the best repayment plan. The best is not always the fastest, and the fastest is not always the cheapest, right? And this is a situation that's unique to your federal student loans, right? All other debt, generally speaking, the faster you pay it, the less you're going to pay. Your federal student loans, you can end up paying more if you try to pay it back faster, right? It's very counterintuitive. It's just how the rules and the regulations work, right? So another reason why to not be so quick to just throw a ton of money towards your student loans, right? So when people ask me what's the best way to pay my student loans, and the most of you, and it was somewhere in the comments that you made, what's the best plan for me, right? The best plan is the one that reduces the risk to yourself and your family, maximizes your monthly cash flow, and reduces your total cost of repayment, right? Now, I can always get these first two with my federal student loans, right? If I, walk out my front door tonight and get hit by a bus, right? My student loans go away with me, right? My wife and my daughter will never be responsible for paying back my federal student loans, right? That is not the case with most other debt that you're going to have, right? So that's a huge load off me. It comes with this built-in insurance that nobody else is going to have to be responsible for it. When it comes to maximizing my monthly cash flow, my payment is a percentage of my income, right? If my income goes up, my payment goes up. My income goes down, my payment goes down. Again, you're never going to have any other debt that acts like that, right? If my income goes down, my mortgage stays the same, right? If my income goes down, my car payment stays the same, right? But my student loans, if my income goes down because I'm changing jobs, right? Or my wife goes on, maternity leave, or I take paternity leave, or, I take some time off because my family's sick and I have to care for somebody, right? I can have my student loan payment dropped all the way to zero if I don't have any income, right? That is hugely powerful. That is some of the best insurance that you'll ever have for something that has a six-figure number tied to it in most cases, right? So that, paying based on my income, I really like, because it keeps me from paying more than I have to, but it also gives me that insurance in case I have something happen to my income or my spouse's income, where I can lower that monthly payment as well. And reducing my total repayment cost. This is the one that everybody seems to be most concerned with. This is the one I'm least concerned with. Now, will I pay the absolute lowest total dollar that I can using an income-driven plan and planning for the tax on forgiveness? Maybe, maybe not. But I don't really care, right? Because it's going to be within a reasonable range regardless. Now, if your debt to income ratio is greater than 2, then you will get this one too, right? So, but if it drops below 2 and it's below 2 for a long period of time, then you'll probably pay a little bit more than you would if you try to pay it off in 10 years, but then you're going to forfeit this cash flow flexibility, which to me is way more important, right? Because I can take that money and do other things with it that's going to outgrow that difference in the total repayment cost versus paying quickly or using that money for other things. Right? So what's the best strategy? If you're on a forgiveness track, then choosing repay and switching to the new version of IBR. If you're not eligible for the new version of IBR, then use pay as you earn. If you're not on a forgiveness track, I would still get started with repay, right? Or use a standard 10-year plan. right? Repay will give you that option of having that $0 payment for the first year and a very low payment for the second year. And then your income will jump up and will probably produce a payment that might even be greater than the standard 10-year plan payment. But you'll accelerate that payment, that payoff naturally based on your income growth versus trying to force it too soon before your income can actually support that. All right, so how much do you have to pay for your student loans each month? All right, so this is a question for the chat. How much do you have to pay for your student loans each month? I'm going to use this too to kind of, I see there's quite a few questions and such in there. It depends. Actually, it doesn't. Not for this one. The exact number depends, but this is more of a conceptual answer. How much do you have to pay for your student loans each month? 10% of your discretionary. So what is that? What is 10% of your discretionary income? The minimum, exactly. You have to pay the minimum. That's exactly right. Right, whatever that minimum is, if it's an income-driven plan, it's going to be 10% of your discretionary income. If it's a standard 10-year plan payment, it's going to be the payment determined based on your principal interest rate and the minimum required to pay that balance to 0 in 10 years. Right, but you have to pay the minimum each month. Right, so I want that minimum to be as low as reasonably possible. Right, and I can get that using the income-driven plans every time. Right, now you can choose a time-driven plan, but in most cases, you're going to end up paying more than your income requires. Right, so you can use a time-driven plan on your federal student loans, just like the standard 10-year plan is a time-driven plan. Right, you can extend it out to 15, 20, 25 years. If you consolidate, you can extend it to 30 years on your federal student loans. Private student loans all operate on time-driven plans. Right, traditional repayment, conventional, however you want to call it. Every other loan, car loan, mortgage, private student loan, all operate on time, right? The time frame, your principal balance, and the interest rate set the monthly payment, right? So it doesn't care what your income is, right? Your federal student loans are the only ones that allow you to make payments based on your income. Right, so just before we move off of this concept of the time-driven versus income-driven, please don't refinance your federal student loans into a private loan. Right, now this is going to go bonkers again once the pandemic forbearance benefits end. Right, the private lenders are dying to get a crack at your student loans, and they can't compete with the federal student loans. Right, the zero interest, the zero payments, the forgiveness provisions. Right, so and right now they're literally crying about all of these benefits that are going on. In fact, SoFi sued the Department of Education, saying that the Department of Education helping borrowers not accrue interest and not having to make payments was hurting their business. And they're suing to end those benefits. And that pretty much tells you everything you need to know about SoFi and the private student loan refinancing lenders. Right? They're in it to suck as much money out of you as possible. Right? So just be really careful. And you will never have the flexibility or the insurance on a private loan that you already have with your federal student loans. You have to be very, very, very careful. And now it's not as big a deal now because the interest rates have increased, but before when the interest rates were so low, the private lenders were like, oh, we'll give you a 1%, 2% interest rate if your spouse will co-sign or your family member will co-sign, putting them on the hook for those student loans if something should happen to you. Right now the interest rates are not that favorable, and your federal student loan interest rates are almost going to be better than what the private lenders can even offer you now. So there's even less reason to do that. But as soon as repayment starts back up again, it's going to be cuckoo pants again, right? Everybody, it's been off for so long. People have lost touch with what interest look like, what a minimum monthly payment looks like, how much they need to pay to get above that interest. And that's when the private lenders are going to, start sending out that prolific marketing material again, trying to lure you back to those private refinances.
For those borrowers that do have private student loans already, in addition to their federal student loans, would you recommend focusing on paying those private loans off first while the federal student loan payment is zero or close to it?
Yeah, absolutely. Yeah. So the goal there, if you have both federal and private loan types, is to get your federal student loans to have the lowest monthly payment they can have, right? Which we established can be zero if you have a tax return that shows low or nothing on it, right? And then focus paying off those less flexible private loans first. Even if they have lower interest rates, they're still less flexible, the private loan. Right. So if you're going to accelerate the payment of anything, accelerate that private loan payment before you worry about paying anything more towards your federal student loan. Okay, so just to give you, here's what those income-driven plans look like. This is what they're probably going to look like after those changes take effect. Right, so that's why we're looking to see if you're eligible for the new version of IBR versus pay as you earn. So just as a, sorry that this wasn't supposed to show all at once like this, but I wanted to give you an idea of what the time-driven monthly payments look like, right? So the 10-year time frame, let's say for a $300,000 balance, is a $3,300 a month payment, right? If you want to accelerate that, which most students and recent graduates have some very lofty goals of paying their loans back quickly, let's cut that time frame in half. Right, you're nearly doubling your payment, right? $5,800 a month, right? That's not going to leave you a lot to work with, right? So that's the problem with these time-driven plans, is that in order to pay them back faster and to reduce the interest that you pay, you have to greatly increase the monthly payment. Now, if this payment looks too high and you want to extend it, let's double that time frame. My payment comes down, but it's still pretty high, right? But then the interest goes way up, right? This is why anybody with a traditional loan encourages you to pay it back as fast as possible, because time-driven repayment options are pretty inflexible, and you're going to pay a ton of interest unless you can pay it back quickly, right? Let's say you have $120,000 income and you're living in, let's just pick Pennsylvania. Right, as a single person, you're going to have $7,300 a month to work with, right? In this example, I mean, that's nearly half of my after-tax take-home pay, right? If I've got $200,000 of student loan, that's still close to a third, right? That's too much of your income that's going towards a student loan payment, and you don't have to do that. Right, so that's where you want to compare, and this is where the overlap comes in with the debt to income ratio and the gray zone, and how do I know, which one to use? This is a pretty quick calculation, right? There's a bazillion calculators out on the internet that'll let you put in your principal, your interest rate, and the amount of time you want to pay back your student loan and crank out a monthly payment. If you're proficient with Excel, you can do it in Excel or Google Sheets too, right? That's where these tables came from, right? But you can compare that payment against what your income requires you to pay. Spoiler alert, it's nowhere near these numbers, right? At $120,000 income, right? It might be close for the $100,000 person, right? But let's see what that number is, right? So how do they calculate that monthly payment, right? They use that, some of you have already referenced it in the chat, the percent of discretionary income, right? So what is that? Your discretionary income in the Department of Education student loan repayment world is your taxable income minus 150%, or for the new version of Repay, 225% of the federal poverty guidelines, right? So the bigger this percentage, the more they're subtracting off as kind of that essential living expense allowance, if you will, right? So taxable income minus this factor comes up with your discretionary income. And then the repayment plan you choose sets the percentage. The newer versions are 10%, the older versions are 15%. Right? So if we have that $120,000 income and we're using that new version of Repay when it becomes available, our discretionary income is $87,000. Our minimum monthly payment is $727 a month. right? A fraction of what that standard 10-year plan payment is for those $200,000, $300,000, $400,000 student loan balances, right? Even for the 100,000 balance, right? Which you would think would be closer, right? But these plans are becoming more and more beneficial, right? So that $100,000 principal at 5% on a standard 10-year plan payment was about $1,100 a month for the minimum monthly payment. These newer income-driven plans are actually below that, right? So there's still a pretty significant difference there. So even if I had $100,000 of student debt and $120,000 income, I'm gonna try to use repay or pay or to get started, because I'm gonna have a little bit more flexibility as I'm building that budget and learning about my finances as a new practicing veterinarian. So this is different from the how much you have to pay. How much should you pay? Right? So after doing this again for more than a decade, most of you, for whatever reason, there's like this magic number that everybody's walking around in their head with, and it's somewhere between $1,000 and $1,500. And I don't know where that number comes from, but it's really consistent, right? But when we start looking at, how much do I have to earn in order to justify or generate a $1,500 a month payment towards my student loans, it's $210,000 taxable income, right? So what does this tell us? It tells us that you don't have to pay $1,500 a month towards your student loans until you're earning $210,000 a year, right? So don't pay your student loans like you're earning $210,000 a year until you actually are, right? And some of you may, and you may quickly, right? But there's really no good reason to do that right now. There's better things you can do with that money to jumpstart other areas of your financial wellness, and you'll still do a really good job of paying your student loans to either zero or reaching forgiveness if you're sticking with those income-driven repayment options. All right, so we have to talk about the forgiveness, right? Again, there's this tax exemption between 2021 and 2025. I think somebody asked the question in the chat earlier, what gets taxed? And it's whatever's remaining, right? The principal, the unpaid interest, the total balance is canceled, right? And there's, IRS is skilled at handling canceled debt, right? Student debt is not the only thing that can get canceled. Mortgage debt, credit card debt, other types of debt can get canceled. And they treat that as if you earn that as income, right? So if you have canceled debt, they'll give you a 1099-C that you'll report on your tax return as other income, right? Which is what puts you into some tax bracket, right? Depending on what those tax brackets are at that time, that's what you'll pay in taxes on that student loan forgiveness.
And what about that unpaid interest subsidy? Is that also considered taxable?
No, the interest that is covered by the government through revised pay as you earn is not considered as taxable income. I don't know how they get around that, honestly, but it is not considered taxable income. Paying student loans off in a reasonable amount of time without having too much interest accrue, right? So I know everybody is worried about the interest, right? But if the interest accrues until you hit forgiveness and you end up paying 30, 35, 37%, having a 63% discount on something is a pretty good deal. Right, so are there any penalties for paying more each month than needed? No, you can always pay more than the minimum on your student loans. But does it make sense to do so? Right? If you pay more than the minimum and you still end up hitting forgiveness, you're going to just end up lighting that extra money on fire, as we demonstrated in my forgiveness plan exercise. All right, public service loan forgiveness. A few of you asked about that, right? So public service loan forgiveness is a special benefit. It's not a repayment plan, right? So a lot of the same concepts are going to apply, right? You want to have that tax return on file, consolidate so all of your loans are eligible for public service loan forgiveness. Only direct loans are eligible. right? Health profession student loans, loans for disadvantaged students, Perkins loans, those older Pell program loans are not eligible for public service loan forgiveness. But if you consolidate them, they will be. So direct loans, you have to use an income-driven repayment plan. And then the other pillar of public service loan forgiveness is working for a qualifying employer, right? A nonprofit, right? And there's a lot of nonprofits in veterinary medicine, right? Shelters, zoos, aquarium. Most of you are sitting in one right now, right? All of the academic institutions are 501c3s, nonprofits, right? So your internship there, potentially your residency time there, if you're working as an academician in one of these institutions, that can qualify you towards public service loan forgiveness, right? So if I'm going to be doing one of those internship residency pathways at an academic institution, I'm going to try to log some public service loan forgiveness credit along the way, right? I may need that, right? Because public service loan forgiveness only requires you to make 10 years of payments before they forgive your student loan, and there's no tax, right? That's part of the law, right? There's no tax regardless of what exemption is in place. It's always in place, right? So public service loan forgiveness is the holy grail of student loan repayment if your career is taking you to one of those nonprofit employers. Choose repay. Again, repay is going to be kind of the utility plan here when it comes to especially the new version of repay, right? So that's going to be your best repayment strategy for working towards public service loan forgiveness. But any of the income-driven plans will work. You never know where your career may take you. I can't tell you the number of cases, you all being the cases, that we field 2, 3, 5 years after you graduate, where you start in private practice because that's where the majority of the jobs are, but then you find some opportunity that brings you into the nonprofit sector, right? Putting you now in line to potentially benefit from public service loan forgiveness, right? So again, it doesn't make sense. What kills me, inside is where those people graduate and they're throwing tons of money at their student loans, and then they find this magical opportunity at a nonprofit that they've always wanted to work at, and now they're in line to receive public service loan forgiveness, and they just threw all of that money they didn't have to towards their student loans, and they can't get it back, right? And they're now on path to experience public service loan forgiveness. That happens frequently, right? You never know where your career may take you, right? So there, again, let some things play out. You can keep your payments really low in those early years. While those things are playing out, you start boosting other areas of your financial wealth and wellness. And if you end up in a position where you can benefit from public service loan forgiveness later, then great.
A couple questions about, can you work part-time for a 501c3 or PSLF eligible employer and still qualify?
You can, but you still have to meet the minimum requirements, which are 30 hours per week on average, right? So you can work part-time as long as you're still satisfying those 30 hours per week on average to meet the public service loan forgiveness requirement. And you could do that through multiple nonprofits, right? It doesn't have to be at a single nonprofit. It can be at 2 or 3 or 5. I mean, you can, as long as you're combining to average at least 30 hours per week with those multiple employers or a single nonprofit employer, then you're meeting the eligibility requirements for public service loan forgiveness. Here's the veterinarian who had $430,000 in student loans, zeroed out, right? Zero balance through public service loan forgiveness. Right, so people are receiving this. I know there's a lot of terrible news out there, and the way it was set up initially was really clunky. And they're going back now and helping those people actually get the forgiveness credit that they earned and should have gotten originally. But they're ironing out those wrinkles. And there's a lot more information around these plans now. It's a lot easier to make sure you're doing the right thing than it used to be. So don't be discouraged by some of that that negative news out there on public service loan forgiveness. It's happening, and people, our colleagues, are receiving it, every day. All right, see where we are. I know we're kind of getting long in the tooth here for the evening. Let me see. me skip ahead, and you guys all have access to these slides. So I just want to cover a couple of these high points, and then we'll get back to the questions before we close it out tonight. So deferment. Deferment is a no-no, right? Deferment is not a useful tool, but unfortunately, the way the law is written around deferment, it's very difficult to get forgiveness credit or to prevent unpaid interest capitalization when you use deferment. There is still a lot of reflex reaction of people who graduate and do an internship, residency, or while they're on maternity leave, they call up their loan servicer and they're like, can you defer my loans? Right? That's a no-no, right? There is no reason to ever use deferment when you can use an income-driven plan instead, right? When you think of the reasons why people use deferment, it's usually because their income is low or zero for some period of time. The income-driven plans will allow you to reduce that payment all the way down to zero if your income's low enough, but still maintain that forgiveness credit, right? So there is never a good reason to use deferment, right? But your loan servicer too also likes to put your loans into deferment because it's easy, right? So if you call and you give them a sob story about your circumstances have changed and I don't think I can make a payment this month, they'll put your loans into deferment probably for a year, right? And that's completely unnecessary. And you won't earn forgiveness credit, and you're going to accrue a bunch of interest and have it added to your principal, right? So you have to be really, really careful about deferment, requesting it, or letting your loan servicer put your loans in it. There's income-driven repayment is always a better option. Right? It's still kind of baked in to the comments that people make, or just kind of our conceptions around what we're supposed to do with our student loans with this medical community, right? It's just kind of that reflex reaction. Oh, I'm doing a residency, I defer my loans. Not anymore, right? It's going to keep you in repayment longer, and it's going to have you paying more than you have to. Word on academic residencies, and if any of you are doing like a master's of public health or a PhD program, you have to be cognizant of the auto deferment, right? It's kind of what put your loans in deferment now, right? All of you are automatically in school deferment while you're still borrowing and in school. But once you're in repayment, you can waive that automatic deferment. Right? So what triggers that is when you're enrolled at least half time in some kind of academic program. So those of you that graduate, do an internship, or roll right into an academic residency, there's probably going to be a half-time school component with that, which will want to automatically defer your student loans. You'll have to reach out to your loan servicer and say, ignore that. I'm going to keep my loans in an income-driven plan and keep providing income documentation when required, so I can keep my loans in that plan, keep logging forgiveness time, and not experience any of that unpaid interest capitalization. All right. I'm going to put this slide up, and I'm going to go through some of these questions that I've been putting off, and I've got another poll for you guys too. So you said to file taxes before we graduate. Do I file even if I have had no income in this past year? Yes, you do. And again, it's because of, you can think of the tax return as kind of the gold standard that the Department of Education will always accept when you're applying for an income-driven payment. Now, there are other ways to get a low or zero payment for your student loans if you don't have a tax return on file. It's just a hell of a lot easier if you have that tax return on file. Right? The other options are real timing dependent, right? And with people receiving signing bonuses and starting jobs sooner, and you just don't want to have to be under the gun, if you will, trying to force your loans into repayment with a $0 payment, when if you have that tax return on file, you bought yourself time and flexibility to secure that zero or very low payment. All right. Last, is this the last poll? Student loan repayment. Okay, this is not the last one, but let's launch it anyway. Yeah, so this, I mean, this kind of gets to what I was talking about earlier. I want the lowest total cost, and yeah, I can certainly understand that, right? But you have to also consider what that might come at the cost of, right? In order for you, the lowest total cost in most cases is if you write a check for the balance today, right? But even in certain cases, you can pay less than what you borrowed using an income-driven plan or qualifying for public service loan forgiveness. So that's not even always true, right? So in many cases, the lowest total cost aligns with those income-driven repayment options if you're not sitting on a pile of cash, which most of us aren't, right? So you kind of have to measure that against what else can I do with those funds that are freed up by paying based on a percentage of my income and potentially hitting forgiveness. All right. Okay, we're going to kind of wind this down here. So we've talked about the filing tax return, building a budget, right? Huge part of this, right? It's really hard to know how much you can put towards your student loans or any part of your financial plan if you don't have a budget, right? And in looking at the data that part of the signal form submission that I've been using for a few years now, we asked, do you track your monthly income and expenses, right? Essentially, are you budgeting, right? And it's, not good, right? So I appreciate the honesty from most people, but 50-50, actually, this is probably closer to 55-45, right? So these others, these are really creative, right? These are some fun answers to read, right? But nearly all of these belong in the no category, right? So you have to build a budget. You have to start knowing what your ins and outs look like. So you have some idea of how much you can put towards all of these other areas of your financial wellness, your student loans included, right? It comes back to that, one of the first things I said tonight, you can't manage what you don't measure, right? You have to measure your finances, ins and outs, right? We do it in veterinary medicine, you got to do it with your finances too. Start thinking about too, what your next tax return is going to look like, right? So if I file a tax return as a fourth year veterinary student, I'm going to have a very low number as an AGI, adjusted gross income, on that tax return. If I graduate in May, start my job in June, the most my income is going to be on that 2023 tax return is about half a year's worth of that income, right? So if I'm earning the equivalent of $120,000 a year, I'm going to have $60,000 on that tax return, right? Which will generate a higher, but still pretty low student loan payment using an income-driven plan payment, which gives me another 12 months of flexibility to boost my overall finances. And if I'm using this new version of repay, the government's going to cover any of the interest that my payment's not covering. Right? So this is how you can use this all strategically to help you build that emergency fund, pay off that less flexible debt, right? Save for the down payment on a home, right? If you're interested in buying a practice or starting a practice, you're going to need cash, right? Where's that going to come from? It comes from this flexibility that you have baked in those early years after graduation if you use your repayment option strategically. All right, let's go to the questions and answers here, because
Yeah, so the top voted question that I think we got tonight was, is it beneficial to pay anything towards the loans your first year out when the required payment is zero once the interest turns back on?
yeah, unfortunately it's not, right? So especially if you're using revised pay as you earn, right? There's going to be some kind of interest subsidy that you're receiving, right? That interest subsidy is net of your payment, right? So what does that mean? Again, I'm gonna come back to that really simple example. Let's say that you're accruing $1,000 of interest a month and your payment is zero, right? If the government is covering 50% of that unpaid interest subsidy, that's $500. If I make a payment of $100, right, now I have $900 of interest accruing. The government is going to cover half of that, $450, right? So my $100 payment just cost me $50, right? It doesn't make sense to pay more than your income requires when you're using an income-driven repayment plan, right? And that was one of those things that's in that top, on that top mistake slide, right? I get it, right? Yes, I'm earning money. I'm not living like a student anymore. My payment is zero. I've got this student debt balance sitting there. It really feels like I should pay something to it. But I'm in many cases, and when that news changes go into effect and that unpaid interest subsidy bumps up to 100%, you're literally lighting that money on fire, right? And you have to be smart with the limited resources you have, right? So it doesn't make sense to pay more than your income requires when you're using an income-driven repayment plan, right? And I can do better things with that money, right? Use that money to boost your emergency fund, right? Use it to max out those retirement funds. But if you have access to a health savings account, make sure you're contributing to those things, right? Tax-free going in, tax-free going out, never pay tax on them if they're growing, right? There's some opportunities out there that go way beyond student loans where you're going to be able to increase your overall financial wealth and wellness, right? And even pay less in taxes, right? Long term, right? So that's one of those other kind of hidden costs of paying your student loans aggressively, particularly if you're foregoing some of the things that are on these slides, is that you're going to end up paying more in taxes than you have to too, because there's no tax benefit to aggressively paying back your student, right? Like it just comes back to, again, being smart with the resources that you have. Oh, okay, let's do this. Oh my God, I haven't even been to the simulator yet. So we're going to send this over to, and I see one of the questions in there, is there a way to add a spouse's income? So yes, you can add that in the simulator, right? So let's come over here to one of our earlier cases, right? So we're going to send that information. We uploaded the information into the My Student Loans tool, right? I've got the information loaded in here, right? I'm going to put my income in, right? Now this person is going to start with a $70,000 income, right, and increase to a $140,000 income. So they're doing kind of one of those emergency internship type scenarios and then rolling into a full-on emergency practice. So we can use the features in the income information section to kind of mimic that as an internship year. And we'll put our post-internship income, right? But because we're going to file a tax return before we graduate, right, we're going to have zero here, right? If we have 70,000 that we start earning in June or July, when we file our taxes in 2024 for the 2023 tax year, we're going to have half that, right? And then when we start earning our ER salary, it's going to be a blend between this and this. So when we file that next tax return, it's still going to be a little bit lower, right? So that's going to buy us some low payments for a few years of student loan repayment, right? So if you're going to add a spouse into this, you can do so here in the family information section, right? Are you married? Yes, no, not yet, right? You can put the year that you're going to get married, how many dependents you have now, or how many you'll have in the future. That plays a role in the discretionary income calculation, right? The higher your family size, the lower your monthly student payment will be. Right? So you can use that, fill in those details for you. If you're going to hit forgiveness, we have to assume some kind of tax on it, right? If we're going to hit forgiveness, we also want to save for that potential tax. And I showed you my forgiveness savings fund. I'm earning on average about 8% per year on that, right? You can get 3% on a savings account right now, right? So somewhere around there is the right growth rate, depending on how you choose to plan for that potential forgiveness tax. If your employer's contributing payments or you want to pay extra, you can see what that'll do to your monthly student loan payment and by adding those extra payments in there. Right, so we run this simulation, right? And there's going to be a bunch of numbers that spit out at you, right? $2,000 a month payment if I want to pay it off aggressively, right? I have 0 payments using those income-driven plans because I filed a tax return, right? This is where I didn't go into those slides because we're running a little bit long tonight, but the next 2 years of repayment, that's what I'm focusing on, right? I think people kind of get blinded by, oh my God, 20, 25 years, how am I going to figure that out? Don't worry about that. I worry about what does the next first year look like? What do the next 2 years look like, right? I've got a significant difference here, which indicates to me that I should take advantage of that, right? If I use revised pay as you earn or the new version when that takes effect, right? There's more than $45,000 on the table in those first 2 years in additional cash flow, right? Over the next 5 years, right? I've got, $80,000 of cash flow on the table that I can use to fully fund a retirement account, put towards the down payment of a home or buy into a practice, right? And I'm going to end up paying my student loans in 20 years here. I'm not going to hit forgiveness, right? It's more than a standard 10-year plan, right? But again, I'm not terribly worried about that because I'm going to make up that difference in those other investments, right? So that's how I use the simulator in that particular case. Now, let's say that this person wasn't going to be working in an ER, right? Maybe they're going straight into practice and they're going to do more of that 120,000 that we were illustrating earlier, right? How does that change the simulation? Right? In that case, it looks like I'm going to hit forgiveness, right? I start to see some numbers populate in this forgiveness table. Right? So I want to start with repay, switch over to this new version of IBR if I have that ability to do so, right? And that I don't have the exact numbers for that projected repayment cost yet, but we're going to add that in the future. It'll be less than this, right? So when I come down here and I look at my forgiveness planning module, how do I start looking at what the forgiveness tax is going to be? What do I need to save in order to do that? Right? I'm starting to get down close to what that standard 10-year plan payment is going to be. Right? It's not the cheapest of the available options, but it gives me significant cash flow to use towards other areas of my financial wellness. Right? Now, what if we boost this starting debt balance up to something higher, which was another common number that I saw in the submissions, for the sessions tonight, right? You're going to see a different outcome, right? You're going to see these forgiveness plans actually end up much less expensive than even a standard 10-year plan, right? So again, it's a math exercise. You really have to run the math, look at what it's telling you in the near term and long term, adjust it as your circumstances unfold, and you can fill in better numbers in these projections and see if it changes anything appreciably for you. All right, what is the recommendation for those who may have a spouse that makes more than enough money to live off of? Is it reasonable in this circumstance to pay the loans off in say 3 to 4 years as opposed to paying over the long term? Ooh, yeah, so living off of the spouse's income. So, generally speaking, same principles apply here. If it doesn't make sense for me to pay more of my income than is required towards my student loans, then it doesn't make sense for me to use somebody else's money to pay more than I have to towards my student loans, right? So your spouse probably also should be maxing out and benefiting from all of those other critical financial wellness items available to them as well, right? So maxing out retirement accounts, health insurance, saving for down payment on a home if that's something you want to do together, right? Looking for other investment opportunities, right? Just because you use somebody else's money to do so and you can, doesn't necessarily make it a good idea, right? There's probably better things you can do in this case, with their money, than paying it towards your student loans, right? So same applies. I mean, somebody asked a question as part of the submission about inheritance. Same idea, right? Should you use your inheritance to pay off a student loan? Unless the person who left it to me specifically said that they wanted it to go towards my student loans, I'm probably not going to do that, right? I can do better things with that than putting it towards my student loan. Again, I've got insurance on my student loans, right? My student loans are going to go away one way or another, right? I'm either going to pay them off because I've earned enough money to pay them off, or I'm going to reach student loan forgiveness, in which case I'm going to pay a significant discount on what the remainder is, right? So if I take that extra money and do other smart things with it, I will come out way ahead than if I use that money just to pay down federal student loans with it, right? And that's really kind of that's the secret of these federal student loans, right? They're going to go away one way or another, right? So quickly doesn't make a lot of sense, right? If you have other options in mind for that income.
While we're on the topic of married borrowers, I know we had a couple of other questions. If you had already filed a tax return with a spouse this year, should you still consolidate your loan?
So it depends on the reason why you're consolidating, right? If you have loans that could benefit from a consolidation, right? Because your loans are going to, whether you consolidate or not, your loans are going to end up in repayment, right? So it's just a matter of when. Consolidation allows you to end the grace period, start the clock ticking using an income-driven plan, but then you have to provide income documentation. And if you have a joint tax return on file, then it's going to require that joint income, right? If you let your grace period expire, you're also going to have to choose a repayment plan, right? If you choose an income-driven plan at that time, you're still going to have to use that joint income when you start repayment at that time. And at that point, I'm comparing, is my payment going to be lower using that joint income versus, say, something like a standard 10-year repayment plan, right? And if I still have loans that could benefit from a consolidation for all those reasons we talked about earlier, right? If I have repayment time in the past that I might be able to impose on my veterinary student loans, if I've got non-direct loans, right? I still want to consolidate those loans to make the maximum eligible for these income-driven repayment plans, right? And again, the tax filing deadline is not passed, right? I think you may want to check or go visit with an accountant on this. I think you could go back and change that tax filing status if it made sense for you to do so, right? So, you may want to look into that if there's a significant enough difference there and it doesn't cost you too much to do that.
Also along those lines, for those that are considering married filing separately, can you address this comment that there are other investment implications, such as not being able to contribute to a Roth, that are worth considering when making that decision?
Absolutely. So those are in the side effects bucket, right? So there are benefits you lose by filing your taxes separately. One of them is being able to contribute to a Roth IRA. Now, if you have access to a Roth 401k with your employer, then you still have an option to contribute to a Roth, right? So you have to weigh, is that Roth IRA in that year I'm filing my taxes separately that critical that I should forego that and pay a higher amount towards my student loan, right? That's where that cost benefit analysis comes in. Helps to work with an accountant when you're looking at filing your taxes separately or jointly, and then running those numbers through the simulator to see, is there enough difference here to justify that decision, right? So yeah, it's part of the pros and cons that goes into deciding this best student loan repayment strategy. Now, I will say that depending on the circumstances, right? I mean, if it's just a couple $100 here and there, then you're probably, it's not worth chasing it. But there can be thousands of dollars on the table just based on how you choose to file your taxes, depending on your spouse's income, whether or not your spouse has student debt, and the state that you live in, right? Community property state. So there could be some pretty significant differences there that you may want to explore. All right, so I see a question here. You mentioned ICR being phased out and are not good plans in general. When I run the simulator on studentaid.gov, that is the plan that shows up with both paying off the fastest and paying the lowest amount overall. Ooh, that's a good one. I'd have to see your circumstances. I generally don't see too many circumstances where ICR is a good long-term plan. So I'd have to, we'd have to take a look at your student debt and income signalment to see why that might be. You got to be a little bit careful using that calculator on studentaid.gov, right? There's very limited options for you to influence the inputs. It's one of the reasons why we built the simulator, right? Some of their assumptions in there are pretty aggressive, right? So, take that with a grain of salt. All right, I apologize if you already answered this, but we do not have 100% in the income-driven repayment plans, then we cannot sign up for the income-driven plans. Now, you can still sign up, right? So this one seems to be a sticking point. So if you don't see 100% here, it just means that you don't have all direct loans, right? You can still use these plans for the direct loan portion you have. And if you consolidate, it will make that new entire consolidation loan eligible for all of these income-driven plans, right? So it's one of those reasons. So you notice that this doesn't say 100. You're like, aha, I have reason to consolidate, right? And if you consolidate, then you will be eligible for all these plans with 100% of that consolidated loan balance, right? So think of that as a clue to push you towards that consolidation. Right? It just identifies the fact that you have student loans in your file that aren't all direct loans. Right? So if you want the 100% of the balance to be eligible for the income-driven plans and potentially public service loan forgiveness, then you have to consolidate them. When we calculate debt to income ratio, do we always use the principal amount or do we include the interest that accrues down the line? I would use the entire balance. So in the debt to income ratio equation, use the total debt balance. All right, what would you recommend for someone who has a debt to income ratio greater than 2, but plans to own a practice and make substantially more, potentially disqualifying them from IBR and totally changing the picture before they reach forgiveness? It's a valid question. However, that's a good problem to have, right? The making too much money situation doesn't preclude using income-driven repayment until you reach that making too much money situation, right? And you can't get booted from the plans, right? Once you're in them, you can continue using them, right? So again, the way the plans are structured, if you're earning more, you're going to pay more, but it's still the same percentage of your income, right? As a practice owner, you also have different ways of documenting your taxable income that may still benefit from an income-driven repayment strategy. So as you're getting to that point, I would be seeking out some assistance through the student debt message boards area. Hey, I bought my practice. This is what it looks like my income is going to be going forward. Does this change my repayment strategy? Right? You can plan for that. Just because you plan on owning a practice and earning a bunch of money in the future doesn't mean you shouldn't use an income-driven plan in the time it takes to get you there. It may actually help you get there sooner, right? So worry about that, cross that bridge as you're approaching it, right? And we can help you, keep that jump in payment manageable, or talk about other alternatives to handling your student loans, depending on where you are in the repayment timeline when you get to that point. I have a small amount of undergrad debt that I started repaying under the standard 10-year plan during gap year. Will I be able to change that payment to an IDR plan? Absolutely. Yep. And that, again, if you paid under a standard 10-year plan, you've got some repayment time. You want to consolidate those loans with your veterinary school loans under that one-time forgiveness count adjustment, you will probably transfer some of that time as forgiveness eligible credit 2-year veterinary school loans. Most of this conversation has revolved around being eligible for forgiveness. What is the best way if everything says I'm not eligible for forgiveness? You can use an income-driven plan as we demonstrated in one of the simulations. You can still pay your balance to zero using an income-driven plan. Right? So there's nothing that says because you're using an income-driven plan, it's going to automatically make you eligible for forgiveness. Right? The benefit of using the income-driven plan is that it keeps you from paying more than you have to towards your student loan. Right? So you have more of that cash flow available to do other things in your financial wellness. Do you have any suggestions for someone that has undergrad private loans of more than one company? Is there a way to consolidate them? Absolutely. That's what those private lenders are there to do, to help you consolidate those private student loans. Now, ideally, you'd want those private loans to be more flexible or a lower interest rate than your existing private loan, right? So you're gonna have to shop around. But I wouldn't consolidate them just to consolidate them. I would only consolidate them if I could get a better deal on those loans, right? So it may make sense to keep them separate. Although it would be simpler to consolidate them, it may cost you more depending on the interest rate and what kind of deal you can get as a new grad. So you may want to wait on that, right? So as a new grad, you may not be eligible for the most beneficial private loan refinancing rates, right? You may need to demonstrate some income earnings and some credit history to them to be eligible for a more beneficial term on that private loan refinance. So with us graduating in May, we should reconsolidate as soon as possible and start with repay. Then once the government changes the student loan plan, switch to IBR. No, I would stick with repay. It's a great question. I would stick with repay for as long as you're benefiting from the unpaid interest subsidy. Right? So as long as your payment is below that interest that accrues, then you can benefit from that unpaid interest subsidy. And then once your payment is greater than the monthly interest that accrues, then you want to start thinking about switching over to IBR 2014. And there is actually a deadline, right, for switching. If you can only switch to IBR 2014 if you have less than 10 years of payments in revised pay as you earn. Right? So that's a ceiling as well. So you want to use repay for as long as you can, but not longer than 10 years. Right. So we're going to start talking about that way more once they finalize those changes and making people aware of that. But that's one of those things too, that's just a little bit too far down the road, trying to keep you more focused on what you need to do now to set yourself up for repayment success going forward. I was told only a few people per area were selected for those programs. Is that true? Is that like a lottery? I'm not
Tony,
sure.
I believe that was in regards to the rural programs.
Okay. Yeah, so for veterinary medical loan repayment, that's completely different, right? Is that what you guys were talking about on the side somewhere? So, and that's not necessarily a lottery. There's a whole application process for that. So, how they determine those areas is a little bit different. That has the state veterinarian involved, but that's a completely separate topic that we're probably not going to dive into tonight. If we choose the old repay plan when it eventually gets phased out, will we be auto-enrolled in the new repay or will we have to manually switch into it? I don't know the exact answer to that. I suspect that you'll be automatically enrolled in it, but once that is released and those changes are finalized, I think we'll get some more clarity on that. I am hoping to receive the $20,000 Pell Grant forgiveness. Should I not consolidate until that is finalized? No, you don't have to. You don't have to wait. You can consolidate, and you'll still be eligible for that $20,000 forgiveness if you meet the criteria, and the Supreme Court allows that to go through. Right? The Pell Grant is just the indicator. Right? Consolidating your loans doesn't change the fact that you still have that Pell Grant indicator in your file. Actually, in the example that we uploaded here, right? This person has that special criteria met, right? That's what that indicates, is that we saw that you received a Pell Grant, which would make you eligible for that $20,000 cancellation, provided the Supreme Court allows that to go through. Is there a timeline for when the changes to repay will be finalized in the next few weeks, months, years? I'm going to say months, right? So it's probably going to, we'll probably learn more later this summer, around the time when the Supreme Court announces those changes, or though the determination of that special cancellation benefit, and as we approach the end of the pandemic forbearance benefits. That's my guess of when we're going to learn more about that, but it could happen sooner, right? And it could also be a little bit later, but my guess is months. It shouldn't be more than a year.
We did have a couple of outstanding questions from the chat. Do you know when Nelnet is taking over for Great Lakes?
I don't believe that Nelnet is entirely taking over for Great Lakes. They are, for whatever reason, shuffling some loans around. My loans are getting moved from Great Lakes to Nelnet. If Great Lakes is no longer servicing loans anymore, maybe that could be, and I just haven't seen that yet. That's something that I would have to look into.
I mean, the last one I have here is, can you file an electronic tax return if your AGI is 0?
Ooh, that's a question for an accountant. I don't know. I think you can, but I'm not entirely sure. I would think so, because most of them, and they prefer that you file them electronically, that you can, but I don't know the answer to that one.
Yeah, and I think in my 4th year, I had like a small amount of student ambassador money, so I can't recall.
So I think that's it.
All right. Well, great. Excellent question. Great engagement. Thanks for everybody that stuck through the whole thing. I know these are long, but there's a lot of information. But hopefully that gives you enough to start thinking about, get the wheels turning and get that repayment strategy in motion, and also some of the resources that are available to you to ask more questions as those questions come up, and they will come up, right? So, keep asking questions, keep doing some math, and we'll help you come up with some answers.
Thanks so much, everyone. We'll be sending out a follow-up email as well with the recording, Dr. Bartel's presentation, as well as some other helpful information.
Great, and thank you, Rebecca, for moderating, and thanks, Jordan, for being behind the scenes and chiming in on my fishing pictures. Appreciate that.
Thanks, everyone, for being here.